Hello guys, how are you doing? My name is Anna Piernell. I'm a realtor here in Houston and surrounding areas, and I'm the team leader of Piernell Property Group. Today, I'm here with two fantastic guests where we're gonna be discussing important information about the real estate market. Jesus Sainz.
Hi everyone, my name is Jesus Sainz. I'm part of the Piernell Property Group. I'm a real estate consultant.
And Paul Mitchell.
How's it going, everybody? Paul Mitchell with the Mitchell Mortgage Group. I'm a mortgage lender in the Houston area, serving all of Texas.
Fantastic. So just to let you know, lately we have been discussing with a lot of clients some of the most important questions and fears that they have in the current market. And the one question that comes very recurrently is what is going on with the interest rates? So just for you guys, the ones that are new in the real estate home purchasing market, I'm gonna give you a very brief summary of what has happened in the last 3 years. If you remember, in 2020, we have record interest rates that were in the low 3%. And everybody remembers this, right? So in January 2022, we actually started to hit again the 3%. And in February 2023, 1 year later, we actually hit the 6%. And everybody started to freak out. A lot of people waited, trying to catch the low interest rates again. And some of the few ones actually went into buying their home, thinking about refinancing in the future. Where, as it's very hard to catch the market, what happened is that in March 2023, the interest rates actually hit the 7%. They came down a little bit and they were steady in the 7s, and then in July, something happened. They started to reach up again. So actually they hit the 8% at the end of October. And after that, we are currently in the low 7s, high 6. And this is why today I'm with these two fantastic people, Jesus and Paul, where we're gonna be discussing what's going on with the interest rates.
I mean, obviously, the major two questions that they have is, and this is where Paul can help us, is obviously it's been erratic. It's been going up and down as of late. Is tickled down a little bit, but is what can they do today? Meaning intentional buyers trying to purchase something in the next 2-3 months, based on all these. And the next one is those that might be waiting for summer, for instance. What can they expect the interest rate might look like by then?
Yeah, we have a lot of conversations with our clients, sometimes together, sometimes separately. But what I've told most people and what the common narrative for 2023 has been is anybody who's decided that they are going to wait and based on interest rates have only seen the rates tick up higher. Most people don't understand how the rates actually work. They're just bought and sold on the bond market, just like, everything else, right? It moves up and down based off of daily movement. It's not, the Fed doesn't make an interest rate change and then everything follows that. It's usually leading up to those Fed interest rate changes that the banks are already making, moves, buying or selling. And that's what's changing the interest rates on a daily basis. So if you can imagine that if you were a stockbroker and you were trading, mortgages, you would want to get ahead of these interest rate hikes that are coming from the Fed. So typically what happens is that the interest rates have been taking a sharp increase, and then they've trickled back down as data has come in after, the Fed has released their interest rate changes. So but it always goes up twice as fast or 3 times as fast as it comes back down, right? So, and that's a general rule of thumb for anything in the marketplace. But
right,
it's been but what's happened over the year is that these sharp increases have been so drastic that the trickle down of, the rates coming kind of settling back in after it just hasn't been enough. So the rates have continued to climb throughout the year. As you said, fives or sixes, and then we were seeing sevens, and then eventually we came to an eight number, right? Which is, not a great thing to show your clientele, but I think it's a necessary thing to show people that look, rates are going to be high, right? The years of 2 to 3% interest rates are over. That's free money, right? That's free money, and that's not available. And that's really what's caused the inflation is all this, availability of free money essentially that you can go and invest and do all the things that you want to do, and it doesn't cost you anything. That time has passed, right? Which is why we have to change the interest rates. All of that being said, showing clients, an 8% interest rate hasn't been pleasant, but at the same time, it's a necessary thing that's had to happen so that when we start to trickle back down to where I think that they'll settle somewhere in the sixes, maybe low sixes, maybe high fives, that seems like a reasonably good number, because coming the other way from 3%, showing somebody a 5% number, well, that's crazy. That's way too high. And so you almost have to break the system in order to make it normal when rates tend to settle back down. So it's been a challenge, right? I'm sure for both, on the realty side and on the lending side, it's been a challenge for everybody, but try to educate people as much as we can and deliver information and help people make the best decisions based on what we think is our fiduciary responsibilities to help them make those decisions. So I hope that answers the question.
Yeah, actually it does. And when do you foresee, I mean, it's a trick question here, but when do you foresee that those rates settle down to the high fours or somewhere on the fives?
Yeah, I don't know where we end up. I think high fives, low sixes is a reasonable number for interest rates in most markets, right? So meaning, not crazy, depression, but at the same time, the economy has just been going so fast that something needed to slow it down. But ultimately, where what I've seen in the last couple of months has been very positive. We haven't seen any interest rate hikes in the last meeting. The core inflation and the headline inflation data has been trending in the right direction, right? So, these things are helping the interest rates kind of trickle down, meaning more banks want to buy those mortgage bonds versus selling them. So that's helped the interest rates settle a little bit lower. Some are at 7%, some are high sixes right now. And after showing people eights for a month or so, and or high sevens, to show a six in front of as the headline number is a good thing, right? And it starts to give people some sense of, okay, well, maybe this is the right time to get back in. But long term, I wish I knew the number, right? And then I could plan my business accordingly based on what that number would be. But
But
there are tools that you can use to kind of help get yourself to, sort of a position that makes sense. Maybe you want to do like a one, I wouldn't do any sort of 3-2-1 buy downs or anything like that, but there are tools in the toolbox that you can use to buy down your rate a little bit to make it better, especially if you can get the seller to potentially pay for it.
perfect. Hey, Paul, can we expand more on these buy downs? What are those and where work and where they don't work?
Yeah, so I mean, there's different types of buy downs. There's permanent buy downs, there's temporary buy downs, and those temporary buy downs come in different categories of 3-2-1 or 2-1 or just a 1-0 buy down. Permanent buy downs are the more traditional method of, paying a discount point or multiple discount points up front to get a lower interest rate. And a permanent buy down, you're buying down with the idea that you're keeping that loan for a longer period of time, which means that there's a break even point. So you're paying money up front for a lower interest rate. That interest rate is going to save you money monthly. So that monthly savings is what you need to calculate versus what you paid up front to see when your break even point is, right? So usually it's, somewhere between the 3 to 5 year mark before you break even, and that interest rate buy down starts actually saving you money because you do have to pay up front. So that's more of a long-term strategy. And it does work, and there are savings to be had there. But if you're in a high interest rate market and you're expecting interest rates to come down, if you buy 3 points up front, there could be a significant cost to you. And if rates come down and you want to refinance to a lower rate, well, you've paid money up front, right? So that might not be the best strategy for you. So then, you can talk about temporary buy downs. The 3-2-1 is, buying it down, sort of 2%, 1%, then zero, right? And then so the same thing, it's an escrow holdback. So it's not actually really buying down the rate. It's taking some funds and putting them in an escrow holdback. And that money is used to pay the differential in the interest rate. So yes, your interest rate payment is lower per month, but it's on a shorter term period until those escrow funds are used up. So if you're using that money yourself, right, meaning you're buying it down yourself, there's not really any value that I can see. Now, if somebody's going to buy that down for you, a seller or builder, somebody like that, then obviously take the buy downs, but be smart about the term in which you buy it down, because again, once you've bought it down, if interest rates change and you want to refinance, you have money up front. Some of the escrow holdbacks will give you that money towards the end, but each lender is different with regard to how they handle that. So not really a right or wrong answer when it comes to buy downs. You just have to be smart in which you think the market is going to shift, when you may want to refinance. Are interest rates going lower? Are they going to continue at the same rate? And then you can make some decisions on what the best options are for you.
Gotcha. Perfect. Makes absolute sense. So it really depends on the situation of the individuals, right? I mean, it's not necessarily a blank all solution that work in every single situation.
No, and for a lot of people, as people think that interest rates are going to trend down in 2024, will yet to be determined. But if they do, then a longer term buy down might not be the best solution. A 1-0 buy down, meaning buying it down for 1 year, might be the best solution for you. That way, when you get to the point where you can refinance and get into a lower interest rate, then you took advantage of the buy down and you used up that money, and then now that money is gone and you can refinance without any heartburn.
Right. Especially if that credit is being given to you, right? If it's not coming out of the pocket of the buyer themselves.
Exactly. That's right.
Believe that if we talk about today and maybe spring or summer next year, today might be the best time that you can actually get seller's credits to the buyer's closing costs, because a lot of people are still behind the fence. But if the interest rates actually go down, as many are predicting, you can expect more buyers in the market, which are gonna give a more competitive edge to the sellers. So I do believe that what you are gonna be saving in interest rates in a short period of time, you're gonna be losing in the price of the homes if you wait for the spring or the summer. And I need to make a disclosure. Not all Houston is the same. As we are talking, as an engineer, I would say that the market is very compartmentalized. It all depends on the price range. It all depends on the neighborhood, on the location in the Houston and surrounding areas. So we really need to analyze what is the best strategy for you as a buyer to go and negotiate your offers. We are seeing houses that still have multiple offers, and we are seeing houses that sit in the market for several days. Still, whether it can be a mega deal or not is very dependent on the house. Jesus and I always say that the houses behave like the sellers. It all depends on the need and rushes and urgencies, how good the deal can be. So you want to know more about what the market and how the market is behaving, just wait for our next video. Right now, do you have any further questions, Jesus or Paul?
Not for the moment.
Okay, fantastic. Thank you for your time. Thank you for watching us. See you next time. Today, we are at the end of November. So see you next time.
See you.